Good morning, traders and investors. My name is Roger Scott, and I'm the Senior Strategist of WealthPress. Today is Wednesday, December 22nd. Remember, it's a fragmented week. Friday, we've got Christmas. The market is flat. Let's see, Monday, the market was down like there was no tomorrow. Dow was down over 500 points. Yesterday, the Dow was up over 500 points. And now, right before the GDP comes out, at less than an hour before the GDP comes out, it comes out at 8:30. It's right now 7:47, so 43 minutes before the GDP comes out, the market is flat. And that makes perfect sense. Actually, for once this week, this makes perfect sense because GDP is the biggest report of the quarter, and the market just doesn't know what to do with itself. Now, it's not going to directly impact the stock market. It's going to directly impact the bond market, and the bond market is slightly weaker. Now, here's how it's going to play out. Let me give you two scenarios. And remember, it's going to come out an hour before the opening bell. So there's one of two ways things can go. Now remember, this is growth. This is expectation and actual evidence of growth, and we're beyond the 2% target according to the GDP estimates. We're at 2.1%. If the number is weak, let's say the number is at 1.8, okay? Well, that gives Fed some evidence that the economy is not growing as fast as they had planned. And if the economy is not growing as fast as they had planned, they may step back or push back the bond buying program and say, hey, we still need to continue buying bonds. Things are not looking as well. This whole timeline that we gave you guys, that we painted for you a few weeks ago, we may have to change it. That's right. On the other hand, and that would cause the bond market to rally, actually. That would cause the bond market to rally because then that means there's a good chance they'll support the economy more. If on the other hand, the number comes out really, really strong, then the Fed will say, hey, we told you so. We told you things are heating up a little too much and we've got to take action, and we're going to do exactly what we said we were going to do. And if that's the case, the bond market is going to go down because then it would just reinforce what they said. So the reason stocks, as you could see here, are just not doing anything and bonds are doing nothing is because today's report can be really, really meaningful. It can cause increased pressure or doubt that the Fed is going to do what it's going to do if the number is real low, let's say 1.5, 1.6. I'm just making all these numbers up. I have no idea what the GDP is going to be. Based on the numbers that we've seen, the private numbers that we have seen, the numbers are going to be solid. And if that's the case, the Fed is going to pull down the bond market. And if they pull down on the bond market, that's going to impact tech. So you gotta look for, so if the number is really, really strong, it may actually cause tech to go down a little bit because it would cause higher expectation that the Fed is going to do what they're going to do, and that has the most impact on the tech. If the number is weaker and the bond market rallies, then tech will rally because then there's a higher odds that the Fed will back off their plans to curb the bond buying. Now, you may have to watch this a few times, but in this case, it's one of those situations where if the number is really, really hot, it's going to be bad for tech. And if the number is really weak, it may be really good for tech. I think blue chips will be okay either way, honestly. But again, that's one of the reasons why the bond market is barely moving and why it barely moved yesterday, even though it was down 1.5 basis points. And this is the big report. Now, aside from the GDP, you're going to have consumer confidence. That's a very, very big report. And if the consumer confidence is really strong, that may overcome a slightly weaker GDP. You've got existing home sales. This is going to be very, very solid. And then we've got a slew of reports tomorrow. The big one is obviously going to be jobless claims, personal income, durable goods, and consumer sentiment. I actually think consumer sentiment should go all the way up here, but nobody asked me. The Fed doesn't ask me for their advisory. I'm just giving you guys a hard time. But these reports are going to be very important. New home sales, existing home sales, honestly, they've been really, really strong. So even if they're off just a little bit, it may cause a damper in the housing market, but not overrule the data we're going to get from GDP, because that's going to influence existing home sale prices and new home sales as well. So overall, keep your eye on the GDP and keep your eye on the consumer confidence report today. That is going to set the tone for the remainder of this week and beginning of next week, in my opinion. Now, let's talk about global markets. So, Wall Street rose yesterday after Biden announced Tuesday that the government will provide rapid test kits and increase vaccination, but will not restrict the economy. Thank God. Governments in Asia and Europe have tightened travel controls or pushed back plans to relax curbs already in place. I don't like the way that sounds, but it is what it is. Traders were rattled by official statements that Omicron was spreading faster than expected. After airlines, cruise ships, oil, and other travel-related stocks had risen earlier on expectations, tighter control could be avoided. It's all going to be dependent on the GDP and these restrictions the next couple of weeks. Sentiment has also been dampened by the expectation of tighter U.S. monetary policy, and that will be enforced if the GDP is weaker than expected. Is greater than expected. After the Federal Reserve indicated last week it'll accelerate plans to wind down economic stimulus that has been boosting stock prices. They won't do it if the GDP is weak. The Fed changed course after inflation rose to a 4-decade high of 6.8% in November. I wonder if the economy is going to run hot. Traders are also worried about the impact of global supply chain disruptions that are fueling fears of higher inflation. I think that, for the most part, is priced into the market. Now, what should we expect today? Put the call ratio in the middle, nowhere. Coming off of really good highs or lows in the market, that's the bounce. I think we can go a little lower, which would cause the market to go higher. In terms of sector rotation, as I mentioned to you guys yesterday, we are now looking at technology, but not consumer discretionary, healthcare, and real estate. And on a 1-month basis, utilities, consumer staples, healthcare, real estate. So be cautious. But I will tell you this. If the market rallies today, if the GDP, if the Fed, if there's evidence that the GDP is cool and not hot, we could see more consumer discretionary upside. So you got to keep an eye on that extensively today. Looking at each individual sector, let me just kind of give you a gauge of where we're at right now. So the S&P is now finally today, I don't know if it'll stay there, first day above the 50-day moving average. If we go up instead of going down today and not touch the 50-day line, this blue line here, we'll need one more day and then we'll be in bullish land instead of the twilight zone, which is between the 50 and the 200-day line. As far as the NASDAQ 100 is concerned, we are also, again, we need 2 complete days of clearance. 2 days where the lows don't touch this blue line. We're not there yet. We don't even know if today will be a clearance. And the Dow, we're barely above the 200-day moving average. We're just now we haven't even touched the 50-day line, although I suspect we will be doing that later today. So the markets are still on a question mark of whether they'll go higher or not. It appears like they're going to break up higher if the GDP is not running too hot and if the bond market doesn't rally too much. Overall, according to market momentum, and I showed you guys this yesterday, we've got a very, very low level on the 50-day moving average, and it looks like stocks could go higher above this level. Let me extend this. So as you can see here, we bottom out here all the time. As you can see here, 1, 2, 3. This is the COVID crash. And even when we crashed, we went a little bit below, and then we went right back up. So the point is, unless there's some crash, and I'm not really expecting anything crazy right now, unless we find out that this Omicron is 10 times worse than it is, I think things are set to go higher on the broader stock market. And the Russell 2000 is actually agreeing with what I'm saying. So that means we can see a rally out of small caps, which we really, really need right now. Look at that. It looks just like the graph that I showed you with stocks over $2. Very, very similar. So to me, the stock market looks like it's going to go higher, especially a rally from the small caps. And if the small caps rally, more speculative stocks rally, and typically smaller stocks rally when interest rate is not that big of an issue. They don't have as much sensitivity to interest rate fluctuations. So I'm actually looking for a rally from them. In terms of actual stocks, I promised to you guys, because today is Wednesday, that I would give you a strong stock and an option, actionable, and a short trade. My long trade is Prologis, PLD. We recommended this stock at 149 back on the 16th of November. You could find it. It's now at let's see, 150. Now it's at 160. I still like it here. It barely bounced off, and it looks like it can go higher. I would put a stop loss at the 50-day moving average. And in terms of options, I would be going all the way to, I want to go past February. I want to go all the way to, what is this, May, January, February, March, April, May. Yeah, let's go to May. And let's see if we can get the 160 for the $10, this area here. And if you're doing a spread, you could do the 160, buy the 160, and you could sell the 175. Okay? You could do that. So I like Prologis. I like the stock. As you could see here in a second, it is a real estate trust, and real estate trusts are one of the few sectors. Energy and real estate trust goes up when markets are under stress from higher rates. So I really, really like this stock in light of everything we're seeing with the economy. And on the short side, Biogen. I mean, if the rally, if this O variant and if the Delta couldn't get this thing to rally, I just don't know what will. I honestly don't know what will. It looks like it's been going up, if you want to call this up, from 220 to 240. I think it's going to come down again, especially if the heat surrounding Omicron cools off. And in this case, I would also use the 50-day moving average to the upside as a stop loss, and I would use a new low as a profit target. And in this case, we would be looking at puts. We would be looking at puts that expire in January, February, March, April. The other ones are May. This is April. And we would be looking at puts, and we would be going down to probably the 220 strike price or the 230. I would probably do a spread, buy the 230 and sell the 200. That's probably the best way to do it. Probably better than buying the 220s. So I would buy the 230s and I would sell the 200s. Probably fair assessment, and I'm expecting more downside. Now remember, folks, keep your eye on your stops. Loosen those stops. That GDP report, it can cause the craziest volatility you've ever seen. We've been seeing 4, 5, 6, 700, not 700, 600-point moves in the Dow. This is not a time to be a hero. This is time to be defensive. And I've got something important for you on that note. And folks, by the way, I want to hear feedback from you. Support@marketgeeks.com. Send me feedback. Now, before I finish, I've got something good for you, actionable, important. Anyone placing trades during the week may actually be stacking the deck against themselves. Look, every week, thousands of headlines, earnings, bad news, Federal Reserve, China, wreck what may seem to be a perfectly good trade setup. You guys know what I'm talking about. So instead of traders risking their hard-earned cash during the meat of the week, there's a simple Friday afternoon strategy that helps skip all the madness. It taps into some of the most reliable forces in the market, already giving new money crew head trader Lance Ippolito direct access to gains like 62% on PM, Philip Morris, 28% on AMC, 30% on UAL, all in a matter of a couple of weeks. Click on the link below now to learn how to get access to Lance's next trade alert. Do it now. And as always, make sure to like this video, subscribe to this channel if you're watching on YouTube. Stay ahead of this crazy market. Be the first to be notified when I post my next video. And there's a link below this video to Lance's program. You gotta check it out. Do it now. The link is there. And let me know if you like these videos. Support marketgeeks.com. I'll be doing my next video from Miami. Bye.